Hello, everyone, and welcome. Before we jump in, I just want to note that this explainer was prepared by Dr. Samir Al-Rashani with some help from AI. All right, let's get right to it. Today, we are going to unpack a part of the Canadian tax system that honestly causes a ton of confusion: other sources of income. I know it sounds a little vague, maybe even like a scary catch-all category, but I promise by the time we're done here, you're going to have a really solid handle on what it is, what it isn't, and how it all works. So here's our game plan. First, we're going to define what this category really is and bust a few myths along the way. Then we'll walk through the big stuff that's included, like pensions and government benefits. Then, my favorite part, we'll cover what's surprisingly not taxable, and we'll wrap it all up with the one key principle you absolutely need to remember. Okay, first things first. You can't play the game if you don't know the rules, right? And the most important rule here is understanding what other sources of income even means. So picture this. You get some money. It's not your salary. It's not from an investment you made. Maybe it's a government benefit, a grant, or even a gift from a relative. The big question is, does the Canada Revenue Agency want a piece of it? That's exactly what we're here to figure out. Now, this slide right here is probably the most important one in our entire discussion because it gets to the heart of the biggest misconception. This category is not some giant random bucket designed to catch every dollar that comes your way. It is a very specific, very limited list of items that are spelled out line by line in the Income Tax Act. The rule is simple. If it's not on that list, it doesn't belong in this category. That is the fundamental principle. Okay, so if it's a specific list, what's actually on it? Well, let's start with a really big one that affects millions of Canadians: retirement and pension income. Here's the deal with most retirement savings. When you put money into something like an RRSP, you get a tax deduction for it now. The government gives you that break to encourage you to save. But there's a trade-off. When you pull that money out in retirement, that's when it becomes taxable income. So withdrawals from RRSPs, RRIFs, and your company pension plans all fall squarely into this other sources of income category. Now, beyond your own savings, we've got the two pillars of Canada's government retirement system: Old Age Security, or OAS, and the Canada or Quebec Pension Plan, CPP or QPP. These are the foundation for many people's retirement. And yes, you guessed it, payments from both of these are considered taxable income that you have to report on your return. Let's dig into the numbers a bit. For the Canada Pension Plan, how much you get really depends on how much you paid in during your working years. But just to give you an idea, the maximum monthly payment for someone who starts collecting at age 65 is projected to be about $1,433 in 2025. Old Age Security works a little differently. It's not based on your work history, but on how many years you've lived in Canada, and the amounts can change. For example, the government provides a little extra for older seniors, so the maximum for someone 75 or older is just over $800 a month. Now listen up, because this is a really crucial piece of retirement planning strategy. You don't have to start taking these pensions at 65. In fact, there's a huge incentive to wait. For every single year you delay taking OAS past 65, your payments increase by 7.2%. For CPP, it's even better. You get an 8.4% boost for every year you wait. Deferring can seriously increase your income in your later retirement years. So, we've talked about retirement, but the government provides financial support in many other situations, and a lot of that support is also considered taxable income. This is a pretty mixed bag. It includes things like employment insurance, EI, if you unfortunately lose your job, and of course the various COVID-19 benefits like CERB and CRB were taxable. Also on this list are spousal support payments, but, and this is incredibly important to get right, child support payments are not taxable and not included here. You'll also see things like research grants and the income that's earned inside a Registered Education Savings Plan, or RESP, when it's paid out. Okay, let's shift gears to talk about income that can come up during some of life's most significant and sometimes difficult events, particularly around employment and death. It is so critical not to mix these two up because they are totally different. On one side, you have the employee death benefit. This is from an employer, and it has a very special rule. The first $10,000 are tax-free. On the other side, you have the CPP death benefit. It's a small, one-time payment of $2,500. Not only is the amount different, but the tax treatment is too. The CPP benefit is taxed in the hands of the deceased person's estate, not the family member who receives the money. You know, rules are one thing, but a real example makes it much clearer. So let's walk through exactly how that employee death benefit and its $10,000 exemption work in practice.
Okay, so let's say an employer pays out a $15,000 benefit to the surviving spouse. The tax law is clear that the surviving spouse has the first right to claim that exemption. So they apply the full $10,000 exemption against that payment. What's the result? Only the leftover $5,000 is included as taxable other income on their personal tax return. It's a straightforward rule, but a really valuable one.
All right, we have covered a lot of things that are taxable, but now it's time for the part you've probably been waiting for, the Mythbusters. What kind of money can you get where the government does not take a cut? These are the two classic examples, right? Someone hits the jackpot or receives a large inheritance, and the first thought that often pops into their head is, oh man, how much of this am I going to lose to taxes? Well, the answer might just make your day. And here is the good news. In Canada, lottery winnings are considered a windfall, pure luck, so they are completely tax-free. Same thing for gifts and inheritances. Life insurance payouts are also not taxed. Even your winnings from a casual poker night aren't taxed, as long as you're not a professional gambler. And the reason for all this goes right back to that golden rule we started with. If it's not on the government's specific list of taxable income items, it's not taxed in this category. Simple as that. This brings us full circle right back to the start, and it lands us on the single most important principle that I really want you to take away from all of this. This quote says it all, doesn't it? It uses lottery winnings as the perfect example, but the logic applies to everything we've talked about. The Canadian tax system is rule-based. It's not about what feels like it should be income. It's about what the law specifically says is income. You don't guess, you don't assume, you check the list. If an item isn't on it, it's not taxable as other income. So I'll leave you with this final thought. Understanding that our tax system is based on specific, black and white rules, not just general assumptions, is an incredibly powerful piece of knowledge. It empowers you to ask the right questions and to look for the facts. So think about it. What other common financial wisdom have you just accepted is true without checking? Questioning those assumptions is a massive step towards becoming more financially savvy. Thanks for watching.